And speaking of which, what's working in these markets? A little bit of an interesting morning, especially if you're looking at the commodity space. Why don't you give us a little bit of background? I know we've been talking about gold a lot, but gold and silver, and I haven't checked platinum. What the heck is going on? Because they're blowing out all-time highs.
Yeah, silver is up another, what it was, 8.85 cents this morning. They took a brief, I think they closed slightly below $34, and where are we? 34.80.
At least 34.50, I think.
Yeah, I think we're actually through those levels. I don't, gold rallying well through its highs, not to the same degree. Silver always is the high beta metal, and it kind of gets sleepy. Sometimes people forget that. But when it gets to a new level, you've got to respect the elasticity that this may seem like, we put $2 into the market on Friday, another 40 cents on Monday, another 80 cents today. All right, that's $3.20. That's an 11% move in 3 days. That's a lot that's a lot in Bitcoin, let alone silver. Is it rich? Yeah, but you've got to be mindful that we're at levels we haven't seen in a long time, and they're definitely putting anybody either short deltas, whether static or dynamic, to the test. And it will tend to, when silver runs, it tends to run a little bit further than anybody thinks before you get that pullback. So I think it's interesting. I'm watching it, but I would be mindful. And we've seen the Aussie get a little bit of a rebound with that gold and silver. So we're seeing that correlation play through. Not perfectly, because we didn't see it. Again, the battle of correlations on Friday, the move in metals was overwhelmed by the move in the dollar.
Yeah.
So you saw a softer Aussie. Today we're seeing a little bit different story.
Yeah, it's really interesting, especially when you widen out that lens, because silver, even though it's the outperformer of the last several days in this world of, gold, silver, Aussie, all the things that are, correlated to that sector of the marketplace. But it's interesting when you stack them against each other, because gold has obviously put 15 to 20% on top of their all-time highs over the course of the last several months. And silver, if I'm not mistaken, is just kind of right around those all-time highs. It hasn't seen as much upside as gold in the grand scheme of things. I know I haven't looked at the gold-silver ratio in a long time, but is that trading mid-range, or is silver in the last week, has that been able to gain more ground on gold? Has that ratio moved lower?
Much more so. Yeah, much more so. You've seen a well outsized move to the upside of silver relative to gold. So you can call it catching up, whatever you want to call it. I mean, all-time highs in silver was $52. This is back in the 80s.
Okay.
So, but short of that kind of supply-driven spike, there was somebody back then trying to corner the market in silver. I saw like the Duke brothers in orange juice. It was the Hunt brothers at that time. But the reason, over the last 15 years, the high in silver was right where we are right now, this $34 to $36 range. So it hasn't exceeded those levels like gold has, but it has done a very quick sprint up to them. So with that, we'll see that gold-silver ratio, which is the number of ounces of silver to buy 1 ounce of gold. Silver gets more expensive relative to gold. You need less silver to buy the equivalent amount of gold. That ratio is probably trading down near its lows. So something to look at. And I think it speaks for us in the FX world, correlations are dynamic. And because over the weekend when I was in LA, some people were like, yeah, what's causing silver and gold to rally? And it's like, yeah, I can pull out that macro playbook and talk about, election outcomes and inflation, and that's all kind of a waste of time. I think there's always an amalgam of effects. Right now, you've got a market that's moved to a new level, and you're going to see outsized band of movement because people aren't quite sure where value is. Trying to assign reason to it, I think, is the kind of the wasted exercise. It's because they're using more silver in this manufacturing, or there's less silver coming out of this area of the globe. Those are kind of lagging macro things that let people write about it, but aren't really actionable. I want to look more at the fact that we've put on 11% in 3 days. And the best we've been able to do intraday is give back less than 1%. Says there's energy to the upside. I'm not a momentum guy. I don't want to buy an 11% rally, but I want to be mindful of where I look at it and where can I take that outperformance and look at something that's underperformed that has a good correlation and possibly look at that in terms of trade substitution.
Yeah, and this Aussie piece, you know, I know Glenn has crunched a bunch of numbers for you, and we've talked about how in the past it has seen similar upside as that precious metals commodity space. Of course, it's never going to be one for one. It'd be like looking at the Canadian dollar against crude oil and thinking that a currency is going to move as much as a volatile a single commodity. Rarely going to be the case. I mean, this Aussie here probably has an annual volatility of 6, 7, 8%. Versus a silver market that we just talked about climbed, you know, more than 10% in not even the last week of trading. But it does beg the question, you know, how long will this correlation breakdown continue? It's always tough when this happens, Pete. You know, you and I have been through so many of these occurrences. You want to talk about the yield curve inversion that we just got out of a month or so ago, but we were in for over 2 years, or similar breakdowns in the way that you expect markets to move. Of course, markets are unpredictable, but the way that you expect relationships to hold, it can break down for weeks or just a couple of days. It could break down for years, like I say with that yield curve inversion that was abnormal for so long. And this is one of those that feels like, Pete, it is getting to that territory of like, man, how long is this relationship going to be broken down whereby precious metals that Aussie has historically been, you know, positively correlated, and it's not, you know, 0.8 or 0.9 correlation, but it's ranging usually from 0.3 to 0.4, 0.5, decently strong, especially in a currency space where almost every correlation you try to draw between U.S. dollar or any currency to any other market, equities, you know, commodities and everything else, is almost always close to zero. Very random relationships, independent relationships. And you see silver and gold continue to just march higher in this market, though it's, getting a little bit of a bounce today, but we're looking at the weekly chart here, nowhere near its recent highs and nowhere near the levels that Aussie traded at, you know, 70 to 75 cents when gold had that initial run up, that first run up to 2100. And it maybe makes an interesting trade if you think that relationship would potentially converge over time. Then maybe you'd look at, you know, short gold or silver position against long Aussie. If you think that this is, you know, the new normal, there's no correlation here. You know, gold production now has nothing to do with Australian dollar. Then you can either feel free to trade them independently, or you can trade the continued divergence and try to either, you know, ride that silver or gold wave higher. And short this against it, or whatever you want to do. But it's I mean, this is a pretty crazy long-term breakdown here, Pete.
Yeah, it is. And you mentioned Aussie volatility. Aussie is the silver of the FX space. And what I mean by that is Aussie has that volatility that we have relatively constrained volatility. When we get to new price levels or new ranges, you'll start to see that uncertainty and that vol expand quick. Yeah, there's a perfect example. quickly. So right now it's a battle of rate trajectory versus drivers like metals. And the rate story seems to be holding the metal story in check a little bit. So this currency kind of fits and starts around a little bit. But being aware of that, now we've seen the bonds go from 126 down to 118 today. So interest rates are higher in the U.S. That's helping the U.S. against the Australian dollar a little bit. If we think we're at the lower end of this range of interest rates, or the higher end of interest rates, lower end of bonds, maybe that dynamic shifts a little bit and that metals correlation starts to play a little bit bigger role. And we start to see, how will we know? The tape action will tell us.
Yeah.
We'll see bonds hold that range of 118 to 119, and we'll see silver continue to rally, and this gets some legs under it. So don't get so caught up in the story. Stick with the numbers and take a look at the tape action. That's where we find opportunity around divergence and convergence within commodity pairs.
That's a really interesting piece, the interest rate piece, because you're absolutely right that that it does feel like interest rates are the driver of this muted correlation, or this breakdown in correlation, and that will again. You've been trading these markets for decades. I've been looking through this data now for years and years and years, over and over again, trying to examine these correlations historically and how long they can break down and everything else. The one thing that we do know, Pete, is that interest rate story will at some point get settled, and these correlations are very likely to come back in line. The things that we don't know is, when will it happen and from what price points? Because, you have the same thing here, Pete, where you've had huge swings higher and lower in crude over the last handful of weeks here, and Canada is really close to its lows against U.S. dollar because of that U.S. dollar strength, U.S. rates, and everything else, muting that correlation to crude. It's a really interesting piece. And to your point, we will see when it lessens, because you'll just start to see, oh man, crude was up $2 today, and Canada put in 50 pips against USD, or gold rallied $10 today and Aussie was up 50 pips. We're just not seeing that right now. And that's what the trade is. If you're trading in the short term, you can't depend on those correlations. If you're trading in the long term and you're looking for some kind of convergence or divergence, maybe there's something interesting there. Last piece before we get out of here, Pete, I just want to get your
election trade.
I want to get your take on where we are, because now the peso and Bitcoin are the most highly correlated markets, and they seem to be very correlated to Trump. Of course, I'm joking, but actually, I don't know if I am. You saw huge run-up in the cryptocurrency space as well as the Mexican peso going into this week, giving back some of that ground in both spaces here today.
A little bit. This is taking a little bit of froth. We challenged 20 pesos to the dollar and gave back a little bit of ground. This will be interesting to see as it plays through. I've got to imagine, what do we have, 14 days left to the election? I think to a man, everybody wishes this was done. I don't know if there is such a thing as an undecided voter anymore, but it'll be interesting to see if this does convincingly challenge through 20 pesos to the dollar, or we revert back a little bit on the trade. But it seems right now this is leaning a little bit towards, you can look at the predictive markets, you can look at Kelshi, you can look at Polygon, anything where there's people expressing an opinion. You can look at polls. You get differing outcomes. This is a correlated kind of product to the outcome that is leaning a little bit, I would say leaning a little bit long, that there's a Republican victory in short of a Democratic one. Well, whether or not that's the case, we don't know.
Well, and it's funny, the one thing that we do know is that we've had, a Trump election and we've had a Biden election, so a Democrat, and obviously Kamala was Biden's vice president, so similar, and we've seen the market react to both. And what we do know is that it's going to be relatively random for equities in a bunch of these markets, one way or the other. This one has been relatively highly correlated to a Trump victory as he's gained steam in those polls in those different places. This dollar has gained steam on the peso. If he were to lose and Kamala were to win, you might see this market move lower. At least, again, we have no clue what the heck's going to happen. These elections have been crazy, but there's been no correlation in the equity space or metal space or anything else really off of these elections. This has been at least a stronger correlation.
Yeah, and that's why, that makes it interesting. From we're at extremes, we're testing the upside of the range. What the outcome is post-election, really what changes, that's the question we all have to ask ourselves. Because in the short run, no matter who wins, not a lot. So do markets revert a little bit? And that's what we'll have to see.
All right, Pete. Well, thanks so much for jumping on with us. Hopefully you continue to enjoy your pierogi and castle and everything else there in beautiful Krakow. Pete will be back tomorrow morning with Glenn. I think you guys are going to crunch some numbers on Canada and a few other things ahead of the Bank of Canada meeting.